Yes, sir. You can.
Are you able to read, sir? The screen is okay, or
yes, sir. It's visible, sir. I'm not sure about the students. Please,
yeah,
revert. Can you read it?
Anyone can unmute your mic and tell me whether the screen is clear and the
Especially
audio video is clear.
Nandu, Anandu.
Clear, sir.
Yeah.
Yes, sir.
Okay.
Yes, sir. They said it's clear, sir. Yes.
Yeah. We'll proceed. Shall I start, sir?
Please, sir. Please, sir. Yeah.
Okay. Friends, good afternoon to everyone. I think we are meeting after a long time. Probably some of you may be new to see me, but some of them have already seen me. I think second year already we have taken few classes, and there is a long gap now. I think we have to refresh ourselves and what we discussed earlier. And see the entire topic today, that subject was security analysis and portfolio management, on which we have seen the beginning that what is an investment, what is the characteristics of investment, and then what is the risk and return. All these things we have seen. And also what is a financial market, how about the stock exchange, primary market, secondary market, and the trading system in the stock exchanges, everything we have seen. Then we have also seen a fundamental analysis, that is the most important part to refresh when we talk about wealth management or a portfolio management. When we talk about portfolio management, we should know that how to select portfolios, what is the goals of portfolio, what is the objectives of the portfolio, and when to invest, and which stock to invest, what proportion to invest. So all these things, it's a part of PMS. And so we have already, because to reach this level, we have discussed about the fundamentals as well as technicals and about the market indicators, etc. See that today, that the major part what we are going to discuss today, and we have one more session tomorrow about the portfolio management. See, normally that there should be a strategy. What is the strategy? Because then what is the strategy means why we are doing that portfolio. And the portfolio means investment in various stocks. That is what is the purpose of that kind of portfolio is more important to understand. So when we are doing a portfolio investment, and we should know that what is the financial risk involved in each and every aspect of investment, and also the financial objectives. Whether it is a short-term objectives or a long-term objectives, we should know everything. Just a minute, one minute. So the product, the strategy objectives then tailored to our financial situation by selecting the underlying structures and the investment portfolio that are within our profile. I just to explain to you briefly about, when we do the investment, first of all, we should have what is an objective. Why for we are investing, what for we are investing, what duration we are going to invest. So all these things is the major things. So what we have to do, we need to do the financial planning. What is that? What do you mean by financial planning? It depends upon the current circumstances, develop a plan and systematically implement the plan in order to achieve our short-term or a long-term goal. What is that? That shows that anything what we do, we need to have a better planning first. Without a planning, we cannot have a perfect execution. So the implementation will become perfect if we have a perfect planning. That is what the process of entire PMS. The second part, what we have to do is that balancing the portfolio income, because there are some portfolio which gives more income. There are something which give lesser income, depending upon the risk associated with a particular product. Because when we talk about a product, I have already told you, when we talk about a financial product, about the equity and debentures, and there are various kind of debt instruments, and then various kind of an equity investment, then depends upon the each instrument or each asset class have a different kind of risk associations. So what we have to do is that we should first of all understand the different asset class. I am sure that this subject I have discussed with you in the unit 2 and the securities market, wherein we have discussed about various kind of financial assets class available are in the market, and each asset class, what are all the risk associated with that, and what is the golden principles of investment. So depending upon the risk of each product, we need to have a diversified portfolio, so that there will be a risk management as well as an averaging the income, and also we have the reliability and also the stability and the growth and tax effectiveness. These are all the three parts. When we do the planning process of portfolio, what are most important is that we need to understand the quality and the nature and characteristics of different kind of an asset class, and in terms of reliability and stability and growth over a period of time and tax effectiveness. This is the basic of financial product. Okay, now we will come to that main part, that we are dividing the whole topic today into three parts. One is that the breakdown of basic principle and investment policy. Part 2 is that how to construct the portfolio, then how to manage the portfolio. So first we need to understand what is a portfolio management, what is background, what is principle, and what are the policy we are going to adopt it. That is the first part. The second part is that how to construct the portfolio. That means what? How to choose where to invest, what should be the percentage, and how a combination of various risk factors are associated with that. Then how to manage the after construction, how to manage the portfolios. Okay. So that when we want to understand the portfolio management, we need to know what is investment. The investment we have already discussed, that investment means whatever the surplus we have to invest in any of the asset class to have a better earnings, and also there is a growth over a period of time. Okay, if you want to invest, where to invest, then we need to analyze, we need to understand what is the securities, and then what is the nature of the securities, how to assess the securities, and what are the merits and demerits of that kind of securities. That is what an investment requires. And then that is what analysis. Okay. So first of all, we do the investment. I hope that I am clear. I am going very slow to make you understand that what is the portfolio management. Every now and then I will recollect and what we discussed. Okay. So the portfolio management is that it's a portfolio is one part, management is another part. We need to understand the first part of portfolio, that is an investment. It's not a mere investment. When we call it as a portfolio, it is a basket of investment. So that is the reason called as a folios. So we need to understand various class of asset class, nature of assets, and risk associated with it. Okay, that is a one important point we need to I am just recollecting what we discussed. The second is that when we do the portfolio, we need to understand where to invest and what are the securities. That means an asset, financial asset. and what is the goal of that particular portfolio. Is a short-term product or a long-term portfolio, like for example, retirement planning or in education planning or for the marriage purposes or to construct a house. The objective of investment strategy need to be decided. Once objective have been decided, then we need to plan that how many type of asset class we need to include and what should be the duration, and all these things we need to have a better planning so that we can do an excellent execution of the plan. So in that part, we need to do analysis of securities. That is what we have studied in the fundamental analysis and technical analysis. Because unless we know how to analyze the securities, we cannot do portfolio construction at all. And we cannot do portfolio management at all. Okay. Am I clear, friends? Are you clear? Okay. So if we want to do the portfolio management, we should have a better standing about security analysis. When you talk about security analysis, we have a two kind of an analysis. One is a fundamental analysis, another is a technical analysis. When you do the analysis, we have to go for 3 steps. One is that the analyst consider prospects of the economy given state of the business cycle. The analyst determines which industries are likely to fare well in the forecasted economic condition. Then the analyst chooses a particular companies within the forward industries. Okay. When you do a security, the analyst means what I mean here, the person who does the management, who does the portfolio. In this case, for example, you are the person, you are going to do the portfolio management, you are going to construct the portfolio, you are going to manage the portfolio, you are going to review the portfolio. So what you have to do, the first step is that, first of all, we need to understand the prospects of the economy in the given state of business cycle. For example, last 2 years, even today, we are sitting in a COVID situation. See, given this situation, this kind of state of affairs, how the Indian economy or the world economy is doing well. We need to first of all analyze macro level economic aspect of a given circumstances. Am I clear? So what the next what we have to do, once we do the fair idea about the country's economy, we have to go next step to analyze about the which industries are likely to do well. Okay, when I talk about an industry, that does not mean the company. The industry means, that, for example, cement is an industry, IT is an industry, hardware is an industry, steel is an industry, and housing is an industry, financial is an industry. Like that, the sector, that is called an industry here. So given the circumstances of the business cycle, for example, this kind of a COVID situation, whether textile industry will do well or IT industries do well or a cement will, which industries will fare well, that should be forecasted depending upon the economic condition as discussed in the first part. Okay, am I clear? So the third what we have to do, we have to choose the particular companies within the favored industries. What do you mean by that? For example, we think that the summer is, this is a situation, the COVID is the situation, everybody is under the grip of fear of health conditions. So most of the people get positive, then they have to get hospitalized and they have to get a lot of medicines. Okay, this is the current scenario. Then assuming that the hospital, that is a medical industries, will do well because a lot of people are getting admitted in the hospital. So naturally, that the medical sector will do well. Same way, people are buying a lot of medicines and pharmaceutical may do well. Same way, the people go for a testing, so the laboratories like a Thyrocam. So like that, these are all the industries are supposed to perform better in the given economic scenario. Okay, you get my point? Now, within this sector, which will do well? For example, if you take, hospital, let us say that Apollo is the one of the top leading medical sector, hospital sector, Kovi Medical in Coimbatore, KMCH. So then we go for the companies. So within the industry, we think of going for companies. Like when we say pharmaceutical, they have a Pfizer, we have, that there is a who is inventing the latest vaccine, like a Pfizer or microbiology. Like that, there are a lot of companies who are the leading. For example, today everybody is taking Dolo 650. So that means the company which manufacturing Dolo medicines will definitely do well. They have a large sales are happening. So there are 3 steps of analysis when you do the security. Sorry. I'm sorry. Sorry, I am also suffering from cold. Probably I don't know. So cold and cough is there. So we have to understand these 3 steps to do the security analysis. That is called a top-down approach, EIC analysis. What is that? Now we will go into that, exactly how we do the portfolio management. And that's called a well-developed securities exchange. Asset prices are accurately reflect the trade-off between a relative risk and potential return of the securities. Okay, that is called efficient market parity. Once you do that, the portfolio management, we should know what is efficient market parity. That means that it's a well-developed economy. The asset prices, because when you want to buy any asset prices, you should know that what is the right price, at what time we can buy or what time we have to sell. And then only that, suppose we should not do overpriced, sorry, underpriced or like that. So we need to understand the asset price accurately to reflect trade between, the relative risk and potential return. Okay, so higher the risk, higher the return, which we have already discussed, and lower the risk and lower the return. So that it depends upon how kind of a combination, a percentage we mix to decide the construction of the portfolio. So efforts to identify an undervalued securities are a fruitless, because normally, the free lunch are difficult to find, because we should not talk like that. So that we have to decide about market efficiency and portfolio management. What is that? A properly constructed portfolio achieves a given level of expected return with the least possible risk. So the portfolio managers have a duty to create best possible collection of investment for each customer's unique needs and circumstances. That is what we have to do. What do you mean by that? Let me explain a little bit better. So for example, when you do the portfolio, that means what? When you construct the portfolio, what do you mean by construct the portfolios? Invest in various kind of a class. That is called construction of the portfolio. These portfolio objectives differ from person to person. That is what I told you, objective of the investment in the first part. Because I wanted to build my asset class portfolio for buying my house for another 10 years. Someone wanted to have a portfolio income for meeting the sons or daughters' marriage requirement. Or someone needs to buy a car. Like that, the objectives may differ. So according to the needs and circumstances, we have to build our portfolio in all these things. Okay. So that when we do the reducing the risk rather than the increasing return, there are ways to manage primarily involves the reduction of the risk rather than increase the income. So there are two, the risk and return are closely associated. That is what I have already explained to you. And when you do the investment, well, how much risk is involved in each asset class, then what is the likely return we are going to get it? This is a very big subject, and I am taking a slow one by one. Sometimes you may get confused, but you will get clear when we end up the topic. Okay. For example, consider 10,000 rupees investment. That the 10% per year for each 10 years is a low risk. That means what? Every year, the 10,000 rupees investment have a return of 10% every year. That means for a 10 years. That means that we are targeting a standard return of 10%. That low risk is involved because your return is considerably less. Whereas I choose another portfolio to invest 10,000, which varies the return, some year 9%, some year 11%, 10, 8, 12, 46, 8, 20, 12, 10 like that. In the 10 years, we have to arrive at the average return per year, but that means I am taking a little high risk because the returns are vary from year after year, depending upon the economic condition, depending upon the performance of the particular asset. Okay. This is what, when you do an analysis, which one give you a low risk and low return, high risk and high return. And when you do the low risk, see that the risk, low risk is the blue line, high risk is the blue line, it carries, and low risk is the standard, which gets like this. Okay. We will discuss with a case study all these things. We'll have to discuss with a case study. So when you do a investment portfolio management as a manager, what we have to do, we have to first work out the return requirements and investor risk tolerance and constraint under which the portfolio must operate. These are all in general nature. I am explaining you. Still, we have a lot of things to understand about the portfolio. Okay. And every now and then I just remind you that the things, these are all I'm explaining to understand the basic of portfolio. Because as a policy, what we have to work out, what is the return requirement of my portfolio? Whether do I require 8% return per annum, or a 10% return per annum, or a 12% return per annum, or 20%, or a 40%, or a 50%? What kind of return I require? These expectations may vary from individual to individual. Okay. Then based on the risk tolerance of the individual. For example, if somebody at the age of 35, he has a long age to go, so he can take more risk. Whereas the person who was at 60 or 70 or 80, he has got a less number of years to live, and the age and the earning ability will come down. So his risk tolerance may be low. But even otherwise also, the people have basically have got their own risk tolerance. Some people are interested to take more risk. Some people are not interested to take risk at all. Some people are ready to take a lesser amount of risk. So we have to assess about the number one, about what kind of return the portfolio is expecting. Number two, what kind of risk tolerance that the individual investor have got. And then within that, how I have to construct my portfolio and operate them. Okay. So we need to have 6 steps we need to understand. What is that? I repeat again, this is a repeat slide. First, when we do the portfolio management, we need to understand the basic principles of finance. Number 2, set portfolio's objectives. What is an objective for which this portfolio is constructed? Number 3, the formulate an investment strategy. That is more important. Then have a game plan for a portfolio revision. That means what? Whatever we have invested, and accordingly we have to do certain things. Okay. And then have a game plan. Then evaluate the performance. See how the portfolio is performing. That is what, so revision is something different. and evaluating the performance something different, and protect the portfolio at an appropriate manner. So these are all the 6 steps we have to follow in the portfolio management. What is that? Understand the principles of finance, understand the objectives, formulate the investment strategy, and have a game plan for the portfolio revision, and also evaluate the performance and protect the portfolio when it is appropriate. Okay. So that this is what we have to do that. Now we will come back exactly what so far I have explained to you about the basic understanding to construct the portfolios. Okay. Now what is that? A person cannot be an effective portfolio manager without a solid grounding in the basic principles of finance. So if you want to be a good portfolio manager, you need to understand the principles of finance. Take time to review and all these things, and we have to do that. So there is a distinction between good companies and good investment. Some companies are good, but they may not give you a proper return. So it is that we need to differentiate between a good companies and good investment. The stock of well-managed company may be too expensive. That means what? The price may be highly priced. The stock of poorly run company can be a great investment if it is cheap enough. So then we need to distinguish it between what is the good companies, what is a good investment companies. Okay. Then what is the investment policy we need to understand? That rupee today is worth more than rupee tomorrow. That is what we have to be very clear. A safe rupee is worth more than a risky rupee. What do you mean by that? Today, if I get 1,000 rupees income, is better than what I am going to get tomorrow at 1,100 or 1,200. And also that today, the value of the rupee is more than tomorrow's the value of the rupee. That is what worth is more than today's value. Okay. And the safety investment is better than the risky investment. And these two ideas from the basis for all aspects of financial management. So when you do the basic account for investment policy, you should always remember that today's money is better than tomorrow's money, and safe rupee is better than the risky rupee. Okay. So what is that? Then we need to understand the concept of utility return maximization. What is that? And when you do the utility and how maximize our return. Then when there are various options are available, how to maximize the return. Return means income. Okay. So it is when you do the objectives of the investment, it is very difficult to until they know where they are. What do you mean by that? There is a growth or there is an income. Mean different things to different people. So what do you mean by growth? What do you mean by income? For example, when you buy a land, the value growing, the value get appreciation, but there is no income. There is a growth, but there is no income. Unless otherwise you sell the asset and realize that income. Whereas when you invest in a fixed deposit, then you get every month a return. You get every month the income by way of an interest, by way of dividend, and so on. So we have to differentiate between, or you want to have a growth plan or you want to have an income plan. When we discussed about the mutual fund, I have already explained to you about this concept. In the mutual fund, you have a two kind of think plan. What is that? One is a growth plan, another is an income plan. What do you mean by that? Growth plan, reinvested, appreciate over a period of time, the asset value is growing. Whereas income plan, whatever the income it generates, you have to give me the return. I am taking the income. So accordingly, we have to decide the investment policy and the investment management. Okay, this is what more important. Now we will come for part 2 of construction of portfolio. First part, we decide about the financial policy, objective of investment, and the risk policies, and about the way of doing the growth and income. Okay. Now we are coming to the second part about the construction of the portfolio. See, I am giving the broadest objective of doing a portfolio management. We have to go each by each theoretically in a different way. That's we have another slides where we will look into that. So when you do the investment strategy, that portfolio manager must understand the basic element of capital market theory. That is called informed diversification, naive diversification, and beta. What do you mean by that? See, that normally there is a simple way people tell that don't keep all the eggs in the same basket. So that means what? Don't keep all your asset in all your investment in one asset class. If something goes wrong, then the either income or a loss will be heavy. So you need to have diversified portfolio. When you do the diversification, something will do better, something will do bad. Ultimately, you get an average. When you do the diversification, you need to understand the beta. What do you mean by beta? I'm sorry. The beta means the impact of events on each price. Something when, for example, today the share market has fallen heavily. Last 2 days, the market has been falling. The index have fallen 10%, whereas the particular stock only fell 2%. But whereas some stock fell more than 20%. So the impact of the beta one, how much when the bad news gets, whether it gets 1:1 or 1:02 or 1:2 or 1:4 like that. So there is a defensive stock, there are weak stock, which we need to understand about the beta impact. So then also we have to think about diversifying not only the domestic way and also in the international and the emerging market. Okay. When you do the security analysis, we have to classify the preferred stock called a blue chip, defensive stock, is cyclical stock. What do you mean by that? For example, TCS. TCS is one of the well-known, well-performed, well-governed company. It's called a blue chip stock. Like say the defensive stock. That means that is what I was explaining to you. That when the market falls, all the stock does not follow the same way. See, ITC have fallen heavily, whereas Infosys have not fallen heavily, whereas Reliance have not fallen heavily. It's all defensive. Cyclical stock like a sugar industry or a textile industries, these are all, that basically a cyclical nature. Depending upon the monsoon, say 3 years they will do well, 3 years they will not do well, like it depends on the agriculture conditions and government policies and so on. So we need to understand the blue chip companies and stock and cyclical stock. So all these things, how do you know that when we do the analysis? Same way, we have to depend upon the equity and the debt securities. So we need to diversify some portion in the equity, some portion in the debt, because the securities or the equity is a high risk oriented, whereas the debt securities are lesser risk oriented. So we have to analyze in such a way that accordingly we have to construct. That is the reason depending upon the bond, depending upon the duration, depending upon the pricing, we have to choose some of the debt securities. Also like the pension fund, these are all the fund which, that directly invest in a fund where it gives a better return and are aiming for a longer period and also have a significant exposure in the real estate. Okay, when you do the construction, we have to see the conditional changes and the portfolio maintenance. Now there are two kinds of manage the portfolio. One is the passive management, another is an active management. Now having constructed the portfolio, and again I will go into the next topic where I will explain to you how to choose the portfolio. I am giving a broadest guidelines in this, and based on that things will be explained in the later topic. Now, when you do the management, there is a passive management and also there is an active management. What do you mean by passive management? Passive management follow the predetermined investment strategy that is invariant to market conditions or do nothing. Let the chips fall where they may. That means what? For example, when I do an investment in index-based stock, Sensex, I have explained to you what is Sensex, what is a Nifty, everything. See, for example, when I do a Sensex index, I cannot do anything. Cannot do anything. I will not do anything. It goes automatically. When the index goes up, my portfolio goes up. My index goes down to my portfolio. I simply sitting on what I have invested as per the index concept. So it is a passive. I don't do anything. Whereas in the case of an active management, I reshuffle periodically depending upon the market conditions. For example, you know that when depending upon the economic performance, depending upon each company performance. So I do my reshuffling, tuning, changing, and altering by the existing portfolios depending upon. So I actively do that managing the portfolio. That means that reshuffling, selling one stock, buying another stock, change that, reduce the quantity or increase the quantity depending upon the market outlook. So that is called active management. This is called, both are having advantages and disadvantages. You cannot ask me that which is the one is active is the best way or a passive is the best way. We cannot, everyone have got advantages and disadvantages, but what we choose is more important. And also when we do that, you know, that hedging, when we do the portfolio, there may be market, ups and downs, volatile due to various external reasons and internal reasons, maybe a temporary nature. So I do not want this kind of a volatile in the market should not affect my portfolio. So I always go for some kind of a derivatives that is called an option and futures and all these things in order to hedge my portfolio income. What do you mean by hedging? I reduce my risk doing an opposite area. Thereby, I protect my value of my present portfolio. So in the case of options, again, it's a different deep subject. But however, we need to understand that when you do the portfolio management, we have a hedging mechanism called to do the futures and options and derivatives in order to hedge my pricing things. Okay. So that what you do that when I evaluate the portfolio, how much my portfolio is doing, and whether it is expected directions it's going, and what is the earnings it gives as per my expectations or not, or that it does well or it is earning more. That's kind of like a performance, like how we evaluate you during the examination, how you are all doing well. We conduct an examination, we value your paper, based on that we give you mark, so that we understand each one how you perform in the class. Okay. When you do the performance evaluation, it requires large kind of there is a cash and withdrawals and options and engage in the portfolio, and these are all the fiduciary duties and responsibility for looking after someone else's money, having done some discretion in the investment. Are you clear, friends? Friends, what I just so far explained to you on the broadest way of the portfolio management. I have to take you in my next slides that how exactly we do the portfolio construction and how we do the management, what are the charting required, what are the methodology we need to adopt, everything we will do in my next slides. Okay. Now, basically, I want to brief you because you are going for an examination soon. So I want to give you macro level picture so that you can understand when you read your books, you understand better. Okay, are you clear? Are you clear, friends? So with this, I think that I have a running nose. Probably my voice may not be clear. and I will conclude with this. And for this, if you have any doubts, probably we can clarify. So that with this, after your question and answers, I want to give you one more important information. Friends, any things, any whatever we have discussed today, any queries or any doubts can we discuss? These are all broadest. I told you it's a macro level I have discussed with you today, and I will give basic one by one and in my next slides tomorrow.